Hello everyone, welcome to This Week in the Markets. Information contained in this video is intended to be general advice only and should not be relied upon as financial product advice. Furthermore, the advice has been prepared without taking into account your objectives, financial situation or particular needs. So you should, before acting on the advice, if you choose to act, consider the appropriateness of the advice having regard to your objectives, financial situation and needs. Welcome to this week's market updates. This week had a lot of surprises, particularly in gold, and then the S&P 500. So let's get started. Turning to commodities first, gold shed about $300 from last Friday to Monday. The precious metal is currently trading in the high 1300s, prices last seen in 2010-11, effectively going back 2 to 3 years in the space of 2 to 3 days. Now what caused this sell-off is still eluding analysts, and reasons range from decreasing inflationary expectations, paper gold sell-off, and the usual economic uncertainty and the like. In a bullish perspective, the market is intensely irrational right now, stretched almost like an elastic rubber band. Gold is trading about $330 below its 200 period MA, and 2 standard deviations outside the 20 period MA, which could be a good opportunity to go long. Following the bloodbath in gold, the S&P 500 plunged approximately 35 points on Monday. Speculation is rife as to what caused a 2.3% fall. From a technical analysis point of view, the S&P 500 is currently trading in the high 1500s, and a break below the 1544 level would take it to short-term support at 1487. Technically, the MACD divergence pattern is stronger, with a third top and both lines are pointing downward. Could this be the end of the party at the S&P 500, or is it just the beginning? Looking at other markets, the Russell Small Cap Index is giving off some stern bearish signals, which could easily flow into other markets. The index formed strong short-term resistance at the 93 to 94 level after a sharp decline earlier in the week. The decline also broke through the 91.13 support and could fall further to 89 and 82. Given the tendency for small caps to lead large caps during a downturn, this bearish signal could easily flow onto the S&P 500, whose own bearish signs we have analyzed previously. During the 4 trading sessions ending on April 2nd, the Russell 2000 slipped 1.8%. The Dow, meanwhile, added 0.6% over the same span. Furthermore, the Dow Transportation Average has also formed a triple top and looking ominous in passing the 5800 support. In Japan, Bank of Japan's Kuroda has urged action on public spending and revenue. Kuroda outlined a number of steps to sustain its debt burden. These include increasing sales tax. The dollar-yen has fallen off its 99.6 recent high and bounced off the 96.7 support formed in the last 2 sessions. The pair has been traveling in a stepwise fashion since February, with participants seemingly just waiting for the Bank of Japan meetings and monetary policy updates for any further bullish momentum. The Aussie dollar fell sharply on Monday, but rebounded to form short-term support at 1.03. The Reserve Bank announced that it would be ready to cut interest rates in its latest minutes, as inflationary outlook would provide further scope for further easing. Technically, the pair has support at 1.03 and 1.02, with resistance at 1.05 to 1.06. The euro dollar progressed heavily, climbing to 1.317, trading very close to the upper Bollinger Band. ECB's Governor Draghi still sees gradual recovery in the Eurozone, with the UK approaching triple-dip recession and periphery countries still in fiscal impasse. What does Draghi know that no one else does? Furthermore, the chairman has urged governments to solve their debt problems as the central bank cannot do it for them. In another history lesson this week, the US monetary base and the stock market and the GDP have all been trending higher, at about 6% a year for the last 93 years. The three data series trend in the same direction over the long run, however vary in their relative positions. Eventually, they all move in the same direction, but in the meantime, they can often stumble into different directions. Now this current trend has a startling resemblance to 1940s. Who can guess what happened then? The monetary base back then was soaring ahead of the market on a relative basis. Short-term interest rates were about zero or thereabouts, and bond yields were around 2% like they are now. And the Fed was buying a large portion of treasury bonds as it is now, and the market back then was way ahead of the economy, just as it is now. However, the stock market in the 1940s was falling, but it isn't now, at least not yet. That's all for this week. On behalf of Trading Pursuits, we would like to wish you profitable trading.